Hey guys, what's up? So today we are studying profit or loss in accounting. Alright, so let's get started. First thing we are looking at is nature of profit or loss. We will look at basic concepts as in what is profit and what is loss. Profit. To an accountant, profit means the amount by which revenues are greater than expenses for a set of transactions. Basically, we are saying the difference, the positive difference between revenue and expenses is called profit. And if that difference is negative, then it is loss. What are revenues? Good question. The term revenues means the sales value of goods and services that have been supplied to customers. Whenever you sell a good or service to a customer, they will pay you something for it. That payment, that amount is called revenue. Next is expenses. The term expenses means the cost value of all the assets that have been used up to obtain those revenues. Whatever cost incurred for you in order to earn a revenue is called expenses. Alright. Next, we are looking at a simple example. Over here, we have sold goods for 20,000, whereas our expenses that incurred in order to get that revenue are 15,000. Now, the remaining amount, since the difference is positive 5,000, the remaining amount is our profit. Sold goods, that's our revenue. Expenses, 15,000. So the remaining amount is profit. Next, we are looking at loss. On the other hand, it is possible for our expenses to exceed our revenues for a set of transactions. It can happen that your expenses are greater than revenues. In this case, the result is a loss. The example of a loss is, let's assume our revenues were 15,000 and expenses were 18,000. Revenues minus expenses is equal to minus 3,000. The value is negative, and you can even see the expenses are greater than revenues. So 3,000 is our loss. We have a loss of 3,000 in this transaction. Next, we are looking at the effect of profit and loss on capital. This is super simple. Alright. Why do you start a business? You start to make profit and to increase your capital. Capital is the amount that you invested in your business. Alright. So let's say capital is 18,000. You earned some revenue by selling stock or goods of value 7,000 and you sold it for 11,000. You earn that revenue. So the profit in this situation, 11,000 minus 7,000 is 4,000. And that 4,000 will be added to your capital, which makes it $22,000. However, if there is a loss, then your capital will be reduced or deducted by the amount of your loss. Ding ding ding. Next, over here it's debit credit. You can learn it, but I would say watch the old videos. We have learned about destination and source. It's a super simple trick which allows you to understand debit credit for every transaction in accounting. Next, we have some entries. The reason for this is just to give you an idea. First is rent of 200 is paid in cash. Rent is our destination, so it's going to be debit. Cash is our source, so it's going to be credit. Next is motor expenses of 355 are paid by check. Over here, destination is motor expenses, so this is debit. Whereas our source is check, so bank account is credit. Next transaction is £60 cash is received for commission earned by the business. Cash account obviously is going to be debit because it's a destination. Commission earned or commission received is going to be credit because it's a source. How did we receive this cash? We earned it in commission. Now, last entry is the owner takes 50 cash out of the business for his own use. This is a drawings entry. We have done these in previous videos. Do check them. They will be linked in the description box. Drawing debit is the destination. So you write debit, drawing. Credit cash because it is your source. And yeah. And that's it for this video. I really hope you guys enjoyed it. If you did, make sure to give this video a thumbs up. Do subscribe and share. And I will see you guys in my next video. Bye guys. Bye guys. Bye guys. Bye guys. Bye.